To continue the discussion on risk management, let's proceed to Chapter 12, Practical Guidelines in Reducing and Managing Business Risk. The basic rule is to apply the principles and techniques appropriate to the situation. Risk can be managed and controlled, but success is rare. Hence, the need for proper and careful risk management. Understand the nature of the risk. Some companies view risk as an opportunity. So the starting point is always to accept that risk exists. Understanding the nature of risk involves assessing the likelihood of risk becoming reality and the effect that they would have if they did. Identify and prioritize risks. Identify significant risk both within and outside the organization in order to avoid unnecessary surprises. Examples of significant risk are loss of a major customer, failure of a key supplier, and the appearance of a significant competitor. People behave differently and inconsistently when making decisions involving risk. For example, yung mga investors. They invest based on their risk tolerance. There are those who are aggressive, high risk tolerant, moderate, meaning chill lang, and others who are conservative or high risk tolerant. For a more structured analysis, define the categories into which the risks fall. It will also help in reducing the chances of overlooking other risks. So these categories include financial, commercial, strategic, technical, and operational. Financial, yung mga inefficient cash management, fraud. Commercial, poor brand management, market changes. Strategic, marketing and pricing decisions, resource allocation decisions. Technical, failure of plant or equipment, accidental or negligent actions. Operational, product or design failure. Corporate malpractice. Next, consider the acceptable level of risk. Opportunity cost associated with risk. It is that avoiding a risk may mean avoiding a potentially big opportunity. So sometimes the greatest risk is to do nothing. When you say opportunity cost, it is the foregone benefit. Next, understand why risks become reality. Upon identification of risk, they can be ranked according to their potential impact and the likelihood of their occurrence in order to highlight, first, where things might go wrong and what their impact would be. Second, to highlight how, why, and where the risk catalyst might be triggered. Risk catalysts, these are the factors that can change and trigger the risk. For example, technology, new hardware, software, or system configurations. One example is the traffic congestion change, which was introduced by the Metro Manila Development Authority chair way back 2010 when it was considered as too risky because it introduced a new system. Organizational change, new management structures or reporting lines, new strategies, commercial agreements like mergers and consolidations. Processes, new products, markets, and acquisitions. People, hiring new employees, poor succession planning. Weak people management behavior like laziness, fraud, and human error. External factors like changes in regulation and political, economic, or social developments. Economic disruption brought by this pandemic. Next is apply a simple risk management process. Risk assessment and analysis. The assessment of risk differs from one company to another. For example, there are risks that can be solved using past experience. There are those that are harder to assess or quantify. When a company is focused on meeting short-term expectations, risk with little likelihood of occurrence in the next 5 years may not be so important to such company. Second, risk management and control. Risk management procedures and techniques should be well documented, clearly communicated, and regularly reviewed and monitored. We have here the table of used in assessing and mapping risk. So dito, yung potential impact could be minor, significant, major, critical. The ability to control the risk. No control, weak, significant, and total control. It is important to note that the risk falling into the top right quadrant require urgent action. Yung nandito ay yung no ability to control the risk, and then critical yung potential impact. Kaya it requires urgent action. While those in the bottom right quadrant, critical yung potential impact, but and there is a total ability to control the risk. However, it should not be ignored because complacency, mistakes, and lack of control can turn into a reality. So once the inherent risk and a decision are understood, the priority is to exercise control. Share information, prepare and communicate clear guidelines, and establish control procedures and risk measurement systems. Avoid and mitigate risk. Reduce or eliminate those that result only in cost. Ibig sabihin, yung mga risk na walang benefit or opportunity na naka-attach can be achieved through quality assurance programs, environmental control processes, health and safety regulations, accident prevention and emergency equipment installation, and security measures to prevent crime, sabotage, espionage, and threats to people and systems. Can also be reduced or mitigated by sharing them. For example, acceptable service agreements and insurance contracts. Note that insurance is a form of risk management. For example, kukuha ka na insurance for you to protect the company against risk from loss, fire, etc. So doon, share mo yung risk ng company mo with your insurer or with the insurance company. Create a positive climate for managing risk. The ethos of an organization should recognize and reward behavior that manages risk. Overcome the fear of risk. Taking risks is needed to keep ahead of the competition. So in life and in business, taking risk is needed. See risk as an opportunity and not a threat. Risk is both desirable and necessary. It provides opportunities to learn and develop, and it compels people to improve and effectively meet the challenge of change. Controlling and monitoring enterprise-wide risks. Enterprise-wide risks are the overall risk that an organization takes and holds in order to achieve its strategic aims. So among the questions that could help you in controlling and monitoring such risks are: where are the greatest areas of risk relating to the most significant strategic decisions? What level of risk is acceptable for the company to bear? What is the overall level of exposure to risk? Has this been assessed and is it being actively monitored? What are the costs and benefits of operating effective risk management controls? Do employees resent risk or are they encouraged to view risk as opportunities? Practical considerations in managing and reducing financial risk. If taxation is the lifeblood of the government, finance is the lifeblood of a business. Finance heavily influences strategies and decisions at every level. In order to manage and reduce the financial risk, organizations must learn the following. First, improving profitability. So variance analysis. In costing, this is a budgeted cost or the number of units versus the actual. In our subject, this is interpreting the differences between the actual and the planned performance of organizations. Assessment of market entry and exit barriers. Assessment of how easy or difficult it is to enter or leave a market. When markets are difficult or costly for competitors to enter and relatively easy and affordable to leave, then firms can achieve high, stable returns while still being able to leave for other opportunities. Break-even analysis. It is a cost-volume-profit analysis. It's the analysis of the point when sales cover the cost or where neither profit nor loss is made. Break-even kasi equal lang yung revenues and expenses. Therefore, zero profit. Controlling costs, achieved by focusing on the big items of expenditure, being aware of cost, maintaining a balance between cost and quality, using budgets for dynamic financial management, developing a positive attitude to budgeting, and eliminating waste. The practical techniques to improve profitability include the following. Focus decision making on the most profitable areas. Decide how to treat the least profitable products. Make sure that new products enhance overall profitability. Manage development and production decisions. Set the buying policy. Consider how to create greater value from existing customers and products to enhance profitability. Consider how to increase profitability by managing people. Then second, avoiding pitfalls in making financial decisions. This is achieved by applying the following principles. Financial expertise must be widely available. That is, to routinely make the best financial decisions. Then consider the impact of financial decisions. The impact of finance issues upon other departments and decisions must also be given attention. Avoid weak budgetary control. Budgets are useful not just in measuring business performance but also in making financial decisions. Understand the impact of cash flow. Take note of the importance of cash in organizations. Know where the risk lies. It's not enough to know your break-even point in pesos or in units. You also have to know how and when it will be reached. Third is reducing the financial risk. Among the questions that guide the top management in managing financial risk are as follows. Are the most effective and relevant performance measures in place to monitor and assess the effectiveness of financial decisions? Is there a positive attitude to budgets and budgeting? What are the least profitable parts of the organization? How will they improve? How efficiently is cash managed? Do your strategic business decisions take account of cash considerations, such as the time value of money? So that's the end of Unit 3, Introduction to Risk Management. I hope that by now you understand at least the basic approaches in reducing and managing risks in a business enterprise. So if you have questions or clarifications, just always feel free to send me a message. Thank you.